So hi guys, this is SJ speaking, and in today's video, let's see about open market operations. This is one of the monetary policy tools used by the RBI. This is also one of the banking videos. So before going to the video, I'm personally teaching trading. So if you want to join my mentorship course, you can contact me from the number which I've given in the scrolling below on my video. So I'm totally taking 7 courses. If you are interested, you can enroll in any one of the 7 courses. So now let's go into the video. So what is open market operations? So open market operation is where the central bank of respective countries buys government securities from the banks or it sells government securities to the banks. So this is one of the quantitative conventional monetary policy tools used by the central banks to control the money supply. In case of India, it is used by the Reserve Bank of India. So I will explain what is. So there are two types of monetary policy tools, that is quantitative and qualitative. Under the quantitative, they are further classified into conventional and non-conventional. I will bring a separate video regarding these types, but now let's see about what is OMO. So OMO is belongs to the quantitative conventional category. So before let's see about the OMO, let's see what are government securities. So government securities means GSEC. The short form of government securities is GSEC. That means government bond. So government bond. If the government needs money, so if the government needs to borrow money means it will issue a bond. So suppose if the government needs 10 lakh rupees means it can issue how many number of bonds it decides to sell how many number of bonds it needs to. But for example, if it wants to sell 10 bonds means, so then the face value of a single bond would be, so 1 lakh. 1 lakh is the face value of the bond. So usually a bond consists of face value and the amount of interest pay. So if you are borrowing money from someone, you have to pay interest. So if the government also need to do the same, it has to pay some interest. So that is the interest rate. And how many number of years it borrows money. So what is the maturity period to repay back the principal? So that is the number of years. So number of years is here. So this is the maturity period. So these three are the constituents of a bond: face value, interest rate, and bond. For example, there are two types of ways to sell a bond. So the first way is selling the bond at the face value itself. That is 1 lakh itself, the bond is sold at the face value. And each year the government pays for example, if the maturity period is 5 years means, for 1 year it pays an interest of 5% means for 1 year it pays 5%, and then for 5 years means 25% it pays an interest. So for 1 year you will get around 1 year you are getting around 500 rupees. Sorry, 5,000 rupees. For 1 year you are getting 5,000 rupees, and after the end of 5 years you are getting around 25,000 rupees as interest. But there is also another way. There is a bond called known as zero coupon bonds. So zero coupon bonds are sold at a discount, and after the maturity period they are given, the principal is paid back at the face value. For example, in case of zero coupon bonds, the bond is given as a discount. So 5% interest for 5 years you are borrowing means, then the bond is sold at 75,000. So you are buying the bond from the government for 75,000. But at the end of the maturity period, government pays you back the 1 lakh rupees. So this is the difference between a zero coupon bond and a normal bond which is sold at face value. So these are the two ways that the bond can be sold. So in case of government securities, there are three types. So I will explain what are the three types. So there are three types of government bonds. So one is cash management bills. So cash management bills, which is known as CMB. So another thing is T bills, that is treasury bills. And another thing is dated securities. So if the maturity period of the bond is less than 91 days means it is known as CMB, that is cash management bills. If the maturity period is greater than 91, that is either 91 or 182 or 364. So these are the three maturity periods of the treasury bills. So that is less than 1 year maximum. So this is if the maturity period is maximum up to 1 year means greater than 91 but less than 1 year means it is T bills. If it is greater than 1 year up to 2 years, 5 years, 10 years, 20 years, 40 years, so that is dated securities. Usually the cash management bills and the T bills are sold as zero coupon bonds. That is, the bond is sold at a discount and are redeemed at face value. But whereas in case of dated securities, the bond is sold at face value itself, and the interest is paid on a yearly basis. So till the maturity period. So this is the difference. So hope you got a good clarification about what are government securities, that is the government bonds. So there are two types of open market operations. So why the open market operation is given to this? The way the open market the name is given is because, so if the government directly sells the bond to RBI or to a certain bank, means it is known as directly buying the bond from the government. So it is known as primary market. But if you are already, if you bought the bond from the government and you are selling it to someone else, means it is known as secondary market. That is, you are selling the bond which you have brought from the government in the open market. That is the secondary market. It can be either to some other banks, or it can be either to a common people such as ourselves, because the government bought a retail trading scheme. In olden days, only the government bonds can be brought by the banks, but now after the retail trading scheme has been established, even the common people like us can buy the government bonds, so in the secondary market. So this is the fact. So now let's see, there are two types of open market operations. So open market means secondary market. So already the government bond which is already brought from the government is sold. So that is what we are buying from. It is known as open market. So there are two types of open market operations. One is the sell operation and one is the buy operations. If the government wants to reduce the money supply, if the government wants to control the inflation, means the the RBI performs the sell operations. If the this is performed by the RBI, not the government. So if the RBI wants to control the money supply, reduce the money supply and control the inflation, means it performs the sell operation. If the RBI wants to increase the money supply, if the suppose if the economy is in recession, if the RBI wants to pump in the money into the economy, means, so in order to increase the money supply, in order to increase the GDP growth, means the RBI performs the buy operations. So now let's see about the sell operation. So in case of sell operation, what happens? So from the government, the RBI has brought some government bonds. So this is the primary market, and after that it sells to some other banks. So this is the secondary market. The already purchased bond is sold to the banks. So suppose if the government wants to take observe the liquidity of around 10,000 crore from the bank, means, so it sells 10,000 crore worth of government bonds to the bank. So the banks will buy the government bonds from the RBI and it gives the 10,000 crore. So the transaction is over here. So this is not a repo loan. So this is not a loan. This is actually a selling. Selling takes place. This is not in case of a repo. In repo, that is selling and repurchasing. But here it is the transaction is over. The ownership is transferred from the RBI to the bank. The name of the bond is transferred to the bank. So the selling is over. There is no any repurchase agreement. So in repo loan, there is repurchase agreement, but here in open market operation, there is no repurchase agreement between the bank and the RBI. The transaction is almost over. It is over. So after buying the government bonds, there is no liquidity available in the bank. The 10,000 crore is taken from the economy. So there are no loans available to the bank for lending. So even if the bank lends, there is only fewer amount to lend to the public. So if there is less lending, means to the public and the firms, means the production of the goods and services would be less, and if the productions are less, the income would be less. So if the income is less, the purchasing power reduces and demand reduces, and as the demand for the products and services reduces, the inflation is controlled automatically. So prices of goods and services will fall automatically. So this is what happens in case of sell operations. So what the banks benefit by purchasing the government bonds, means if the bank lends this 10,000 crore to the public, means the public might default. So there is risk of default, but the government never defaults. So the government never defaults. So it will pay back the principal at the maturity time, definitely. So this is a safe and secure investment for the banks. So it definitely buys the government bonds from the banks. And if the bank buys the government securities, it can also use the government bonds in facilities such as LAF. So it can again pledge these bonds to the RBI. So in the repurchase agreement, it can again give the bonds to the RBI and get some money as borrow some money from the RBI, or it can even keep these government bonds in SLR. So if you do not know what is SLR, I have posted a video regarding SLR. So statutory liquidity ratio. So it can maintain the government securities in the form of SLR, or even if it doesn't have enough government bonds to purchase borrow money from the, in case of repo loan, means if it does not have enough government securities to borrow money in the repurchase agreement, means it can use the MSF facility. So marginal standing facility, you can use these government bonds. You can take the government bonds which it has kept in the SLR, and it can use in the MSF. So the government so the banks usually buy if the RBI sells the government bonds, means the banks are ready to purchase the government bonds. So this is useful for the banks. And another case, it can also sell the government bonds in the secondary market to someone else. So if the banks need in a urgent need of liquidity, means, so it can't, if the maturity period is 5 years, but the government can't wait for 5 years, it is immediately needs some liquidity, means it can sell to some other bank or even to us common people like us. If we have the money, if the bank need, if we have the money needed, if we have the money that the bank need, means we can also give the money and buy the government bond from the bank. So this is one case. So next is buy operation. So buy operation means the government gives some government securities to the bank. The bank gives some money to the government and buys the government securities, and from the bank the RBI is buying the bonds. So the banks would have brought some government bonds from the government, and that bond is brought by the RBI from the bank. So RBI buys the back from the bank, which it has already bought from the government. So what happens if the RBI wanted to increase the money supply? So it gives around 10,000 crore to the bank, and the bank gives the government securities worth of 10,000 crore. So what happens? 10,000 crore of liquidity is available to the bank, and it can lend to the common people. So it can lend to the households and firms. So it can lend, and then again the goods and services are produced at a large scale. Then the GDP increases, and the income increases, and the purchasing power increases. Demand for the goods and service increase, and then the growth automatically happens in the economy. So this happens in case of for example, in order to reduce the inflation, the RBI performs sell operations, and the inflation is reduced to some extent. But after that, the economy faces a slowdown. So economy is in a crisis of going into a economy is in a slowdown. If this slowdown continues, the economy might face recession. So in order to stop the economy from going into a recession, in order to recover the growth, the RBI performs the buy operations. So in this case, the money supply is increased, and the growth happens. So this is in case of the buy operations. So these are the two operations which are used by the RBI in order to increase and decrease the money supply. So hope you got a good clarification about what OMO is. So this is one of the monetary policy tools, that is quantitative conventional monetary tools. So I will bring a separate video regarding the types of monetary policy tools. So until then, if you like this video, share it with your friends and family, subscribe and press the thumbs up button, and also press the bell icon so get notified for all my videos. And apart from that, if you want to learn trading from me, you can contact me from the number which I have given in the scrolling below on my YouTube videos. And if you want to open a Demat and trading account, I have given you Zerodha link and Alice Blue link on all my YouTube videos description. You can refer to that description, and you can open the link and you can open your trading and Demat account and start trading and investing from today onwards. So thank you guys. I'll visit you on my next video. Until then, bye bye. Take care.